On Friday, while you were distracted by the flashing red numbers on the Comex ticker, while the algorithms were busy smashing the paper price of silver down to $61.50, two separate events occurred that have effectively signed the death warrant for the global financial system as we know it. Most people see these as two completely unrelated news stories. One is about a software company missing earnings. The other is a technical press release from a Korean battery manufacturer, but they are not unrelated. In fact, if you understand the invisible thread connecting Oracle Corporation to Samsung SDI, you will realize that we just witnessed the beginning of an extinction-level event for the global supply of physical commodities. The media is calling it a market correction. I am telling you it is a trap. They are trying to shake you out of your position exactly 48 hours before the realization hits the broader market. Stick with me, because by the end of this video, I am going to show you the Extinction Equation. I'm going to prove to you why the technology in your pocket and the car in your driveway are about to cannibalize each other in a war for resources that the periodic table simply cannot support. The banks are playing a paper game, but physics is about to flip the table. This is the story of the Pincer Movement that just crushed the global supply chain. Let's go back to December 9th, 2024. Oracle releases their earnings. On the surface, it looked like a standard miss. Revenue hit $14.1 billion. Growing 9%, but the stock dropped 6%. Wall Street analysts, people who spend their lives staring at spreadsheets but have never set foot in a data center, blamed slower cloud adoption. They said the hype is over. They are wrong. Dead wrong. Oracle didn't stumble because customers stopped buying. Oracle stumbled because they hit a physical wall. Larry Ellison and Safra Catz admitted something terrifying on that call. Something that should have sent shivers down the spine of every industrial planner on Earth. They admitted they physically couldn't turn the machines on. They have the chips. They have the customers. Elon Musk is literally begging for more capacity for XAI, but they cannot plug them in. Why? Because the U.S. electrical grid is collapsing. The grid was built in the 1970s to power suburban homes and shopping malls. It was designed for a world where factories shut down at 5 p.m. It was not designed for AI. A single NVIDIA H100 GPU draws 700 watts of continuous power. That's like running a microwave oven, 24 hours a day, never turning it off. Now, put 65,000 of those microwaves in one building in Northern Virginia. That is not a data center. That is a city. And unlike a city, it doesn't sleep. It pulls maximum load every single millisecond. When Oracle asked the utility companies for more power, the utilities said, "Sure. Come back in 7 years." Does this sound familiar? We have seen this before. We saw it in California in the early 2000s with Enron. We saw it in Texas during the freeze. But this is global. It isn't just a wires problem. It's a transformer problem. The step-down transformers required to handle these massive loads have a lead time of 3 to 4 years. You cannot software patch a transformer. You cannot update the physics of copper coils. And don't think renewable energy is the white knight that saves the day here. This is the intermittency trap. Solar panels only work when the sun shines. Wind turbines only work when the wind blows. But an AI training cluster cannot stop. If you interrupt a training run on a large language model for even a fraction of a second, you corrupt the data and lose millions of dollars. So, how do you bridge the gap between an intermittent sun and a constant AI? Batteries. Massive, city-sized battery parks. To keep Oracle running, you need gigawatt-hours of storage. Here is the cliffhanger that nobody is talking about. If the grid cannot supply the power, the tech giants have only one choice left. They have to build their own power plants, and more importantly, they have to store that energy. They need batteries. Massive, industrial-scale batteries to buffer the load. And this is where the first jaw of the trap snaps shut. The battery technology needed to save the AI revolution relies on zinc and nickel-based chemistries to avoid fire risks. Do you know where 70% of the world's silver comes from? It is a byproduct of zinc and lead mining. If the demand for these industrial battery metals spikes, the mining economics shift drastically. But that's just the appetizer. While Oracle was revealing the collapse of the energy grid, Samsung just dropped the bomb that destroys the other side of the equation. While you were watching the silver price drop on Friday, Samsung SDI quietly confirmed the specifications for their new solid-state battery production line. This is the holy grail of the auto industry. 900-mile range. 9-minute charging. No fire risk. It solves every problem that has held EVs back. But there is a catch. A massive, fatal catch that the International Energy Agency is terrified to publish in their annual reports. To make a solid-state battery work, you have to solve the dendrite problem. In a normal lithium battery, little crystal spikes grow inside the cell and cause fires. That's why your EV charges slowly. Samsung solved it. Their solution? A silver-carbon composite anode. This isn't a trace amount of silver. This isn't the microscopic dust used in a solar panel. We are talking about coating the entire anode of a 1,000-pound battery pack. Early estimates suggest we are looking at anywhere from 5 grams to potentially 1 kilogram of silver per vehicle, depending on the performance tier. Let's just pause and do the math that Wall Street refuses to do. If you put just 50 grams of silver in a car, a very conservative estimate, and you produce 10 million of these cars, that is 16 million ounces of silver. But what if the adoption rate isn't 10%? What if it's 50%? What if the Ford F-150 Lightning requires 200 grams because of its size? We are suddenly looking at a scenario where the automotive industry alone requires 100 to 200 million ounces of silver annually. That is more than the entire production of Peru. That is equivalent to a new solar industry springing up overnight, demanding metal that does not exist. Does this sound familiar? We saw this with palladium in the early 2000s. The auto industry switched technologies for catalytic converters, and the price went from $200 to $3,000. It wasn't inflation. It was a physical shortage meeting inelastic demand. But wait, it gets worse. You need to understand the inelasticity of chemistry. Toyota, Volkswagen, and Samsung cannot decide to use less silver. If they reduce the silver content in the anode, the dendrites come back, and the cars catch fire. They are hostage to the periodic table. They will pay $100 an ounce. They will pay $200 an ounce. Why? Because $200 worth of silver in a $60,000 car is a rounding error to them. But to the silver market, it is a nuclear explosion. This is the Pincer Movement. On one side, you have the AI revolution, Oracle, Microsoft, Amazon, hitting an energy wall that requires massive battery storage and infrastructure build-out, consuming zinc, copper, and silver for connectors. On the other side, you have the EV revolution, Samsung, Toyota, Volkswagen, pivoting to solid-state batteries that literally eat silver by the kilogram. And sitting in the middle is the mining industry, which hasn't found a new major deposit in 2 decades. This brings us to the Extinction Equation. The total global mine supply of silver is roughly 830 million ounces a year. Recycling adds another 180 million. That gives us a total supply of about 1 billion ounces. Now look at demand. Solar panels are already consuming 200 million ounces and growing. Electronics take another 300 million. Jewelry and investment take the rest. We are already in a deficit. We are already burning through the above-ground stockpiles. The vaults in London and Shanghai are bleeding dry. Now, add the Samsung scenario. Add 100 million ounces for solid-state batteries. Add the infrastructure demand from the AI build-out. The equation breaks. 1.2 billion ounces of demand cannot be met by 830 million ounces of supply. It is a mathematical impossibility. And here is the terrifying part, the part that should keep you awake at night. The recycling myth won't save us. People love to say, "Oh, we will just recycle the silver from old electronics." It's a lie. Silver is the vampire dust of industry. It is dispersed in microscopic amounts across billions of landfills. It is chemically bound in pastes and films. Recovering it costs more energy than the silver is worth. It is gone. We are burying billions of ounces back into the earth in a form that we cannot touch. And for the solid-state batteries? If you buy a Samsung battery in 2026, that silver is locked in that car until 2045. It doesn't come back to the market next year. It is sequestered. It is removed from the monetary pool for an entire generation. But there is a deeper layer to this crisis, one that involves geology and the byproduct trap. Remember when I said 70% of silver comes from mining other metals? This is the Achilles heel of the entire supply chain. You cannot simply open a silver mine when the price goes up. Pure silver mines are rare. Most silver comes out of the ground when you dig for zinc, lead, or copper. Here is the nightmare scenario. What if the global economy slows down? What if construction slows in China and they need less copper and zinc. The miners will cut production of base metals. And when they cut copper production, silver production falls with it. We could be entering a stagflationary environment where industrial demand for base metals drops, choking off the silver supply, exactly at the moment when the strategic demand from AI and EVs explodes. It is the perfect storm. Supply contracts while demand goes vertical. Does this sound familiar? We saw a similar dynamic in the uranium market. Mines shut down due to low prices, and when demand returned, the supply wasn't there. It took a decade to fix. We don't have a decade. Samsung needs the metal now. Oracle needs the power now. And let's look at where this metal is supposed to come from. This is the geopolitical stranglehold. The West loves to talk about green energy, but the East holds the keys. China doesn't just mine, they refine. They process the vast majority of the world's battery metals. If diplomatic tensions rise, if a trade war escalates, China has a kill switch. They can simply restrict the export of refined silver powder or zinc concentrate. They did it with gallium and germanium in 2023. They restricted antimony in 2024. If they restrict silver exports to keep the metal for their own solar and EV industries, the West is left with nothing. No batteries for Oracle. No cars for Ford. The supply chain doesn't just bend, it shatters. So, why did the price drop on Friday? Why is silver trading at $62 when the fundamentals scream $200? Because the market is inefficient. The algorithms trading on the Comex are reading technical charts from the 1990s. They are looking at the US dollar index. They are looking at interest rates. They are not looking at the chemical composition of Samsung's anode. They are not listening to Larry Ellison complain about the power grid. This information asymmetry is your window of opportunity. But that window is closing faster than you think. We have seen this before, and it is happening again. In 2020, lithium was trading at $7,000 a ton. Nobody cared. Then, the EV mandates hit. The price went to $80,000 in 2 years. A 12x move. Silver is currently in the 2020 lithium phase. The industrial pivot has happened in the labs, but it hasn't hit the warehouse receipts yet. Consider the Shanghai arbitrage. Right now, physical premiums in China are skyrocketing. The Chinese market knows about the solar demand. They dominate it. They know about the Samsung battery. They are neighbors. While New York paper traders are selling, Shanghai is buying. We are witnessing a migration of physical wealth from west to east. The Comex is becoming a paper tiger, a mechanism for setting a price that nobody can actually buy at. Try to buy a monster box of Eagles today at the spot price. You can't. The dealers know. The refiners know. But the most dangerous part of this story is the force majeure event. When you buy a futures contract on the Comex, you think you are buying silver. You are not. You are buying a promise. A promise that can be settled in cash if the metal isn't available. When Samsung procurement officers come to the market, they don't want cash. You cannot build an anode with dollar bills. You cannot code a battery with a wire transfer. They need the physical atoms. If the Comex cannot deliver, they declare force majeure. They say, sorry, we are out of metal. Here is your cash back at the closing price of $61.50. Meanwhile, the real price of physical silver on the private market is trading at $150 or $200. If you are holding paper silver or an ETF that doesn't actually store the metal, you get cashed out at the bottom. You miss the entire move. You get left holding worthless fiat currency while the industrial giants consume the remaining inventory. This is the ultimate rug pull. When Ford and GM realize they can't build their 2028 fleets because Samsung took all the silver, they won't be buying paper contracts. They will be buying mines. They will be going directly to the source, bypassing the open market entirely. This is when the price disconnect resolves violently. This is the cliffhanger we are living in right now. We are standing on the edge of a regime shift. The era of silver as a precious metal for coins and jewelry is ending. The era of silver as a strategic energy metal is beginning. It is becoming unobtainium. Governments are already waking up. Why do you think the US and EU are passing laws about critical raw materials? They know what's coming. They know that if silver runs out, the transition to net zero fails. The AI revolution fails. The modernization of the military fails. If the shortage becomes acute, do you think they will let you buy silver eagles at the coin shop? Or do you think they will invoke the Defense Production Act to secure that metal for Samsung, for Tesla, for Lockheed Martin? This isn't conspiracy theory. This is history. In World War II, the US government didn't ask for your copper. They took it. They stopped minting copper pennies and used steel. When a resource becomes existential to the survival of the state or the economy, the free market is suspended. That $62 price tag you saw on Friday, that is a mirage. It is the ghost of a market that no longer exists. The reality is in the physics. The reality is that Oracle cannot scale without power, and that power requires storage. The reality is that Samsung cannot scale without density, and that density requires silver. You have a choice right now. You can trust the bank analysts who told you everything was fine in 2008. You can trust the paper price that is manipulated by high-frequency trading algorithms. Or you can trust the periodic table. Physics doesn't lie. Chemistry doesn't negotiate. And geology doesn't care about your quarterly earnings. The loops are closing. The infrastructure crisis and the battery breakthrough have converged on the same timeline, December 2025. The supply chain is the victim. The question is, will you be the collateral damage, or will you be the one holding the physical asset when the music stops? The banks smash the price to scare you. They want your silver. They want you to sell so they can cover their shorts before the Samsung orders hit the market. They are relying on your fear. They are relying on you looking at the chart and not the world. Don't let them take it. We are watching an invisible crisis unfold in real time. The patient is the global economy. The disease is a lack of physical resources. And the only cure is a repricing of reality that will wipe out anyone still clinging to the old world. Oracle signaled the demand. Samsung defined the chemistry. The market is about to provide the volatility. Stay awake. The silver bomb has already detonated. The sound wave just hasn't hit you yet.